As a final topic in Chapter 8, we're going to discuss hedging and how hedging might be used to reduce borrowing risk. Now, what we're really talking about here is interest rate risk. We're not necessarily saying that hedging is used to lower the cost of borrowing, but in addition to the cost of borrowing, a financial manager is concerned about the uncertainty of what that cost will be. So he might engage in a hedging transaction. So a hedging transaction partially or fully reduces the risk exposure, and essentially the risk doesn't go away, but we enter into a transaction that will pay off if the risk is actually encountered. So in our example, let's imagine we're concerned that interest rates might go up. Well, we can use a futures market transaction to enter into an agreement where if interest rates go up, that would be bad for us as a borrower. If interest rates go up, our futures contract will go up in value also. So while we incur a cost in terms of higher borrowing costs, we also incur a benefit, which is an increase in the value of our futures position. So the financial futures market allows for the trading of financial instruments as of some future point in time, hence the name future. For financial futures, there's no actual delivery. So we're going to enter into a transaction, and what happens at the end of the time period, in other words, when we get to that point in the future that we have promised to make a delivery, is if we have bought a future, at some point down the road we have to purchase a future, and those two cancel out. If we buy one and sell one, those cancel out. The question is, did we buy it for more than we sold it for? So let's consider an example. In selling a treasury bond future contract, the subsequent pattern of interest rates will determine whether or not the sale is profitable. The purchase price is established at the time of the initial transaction. So let's say we sell a future for a June 2011 Treasury bond contract, and that sale occurs in January of 2011, and we receive as proceeds $100,000. And this we're really dancing around how the futures market works to some extent. The details of that aren't particularly important at this point. The main point here is, notice we've sold before we bought. We essentially have promised to sell a bond in June of 2011, and the price is $100,000 as of today. Over time, as we get close to June 2011, okay, so time passes and we're getting close to 2011, because we've sold this bond in the future, we need to buy the bond. Think of it as buying it so we can make delivery, but actually we sell it, and then when we buy another one, they cancel each other out. If interest rates have gone up, that will cause bond prices to go down, and we'll see that in a subsequent section of the book. Let's say bond prices have gone down from $100,000 down to $95,000. We never actually bought or sold a bond. What we did was we bought and sold a future on the bond, and these are referred to as derivative securities. Futures are a form of derivative. They're derivative because their value is derived from the underlying asset, in this case a bond, and so we end up with a profit on the futures contract of $5,000. The point here is this: if interest rates go up, the company is going to be unhappy because our costs of borrowing have gone up. But if we entered into a futures contract that made $5,000, then our bad luck of having interest rates rise, and therefore negatively impacting our company, is offset by our good luck of having interest rates rise and causing our futures position to become more valuable. And so this is what we refer to as hedging. We've got two positions, one as a borrower, the other in the futures market. The same event, a rise in interest rates, impacts both of them, but it impacts them in opposite directions. It makes our firm less valuable in that we have to borrow at a higher price. It makes our firm more valuable in that the futures contract has gotten more valuable, and therefore we've got $5,000 more dollars. So that's the essence of what hedging is. So in this case, if interest rates increase, the extra cost of borrowing money to finance the business can be offset by the profit of the futures contract. If interest rates were to go down, that's not the example we had, but if they go down, there will be a loss on the futures contract. Instead of making $5,000, we'll lose money on the futures, but we're going to be happy to see interest rates go down because it lowers the cost of borrowing for the firm. In this case, it's likely that we'll wish we hadn't hedged. If the interest rates are going down and we were going to be able to borrow at a cheaper price, we've entered into a transaction which actually caused us to not get that benefit. That's the downside of hedging, if you will. The downside of hedging is while it can hedge against bad events occurring to the firm, it may also hedge against good events, good surprises happening to the firm. Now, interest rates are something that many firms are concerned about. Borrowers are concerned about interest rates. Lenders are also concerned. They might enter into a futures contract because they're afraid interest rates will go down, and they won't be able to lend at as high an interest rate. For multinational corporations, they may have their expenses in one currency. Let's say they have to pay their employees in Mexico in pesos, but the goods are being sold in the U.S. in dollars. That concern about being able to translate dollars into pesos and pesos into dollars might cause the firm to engage in a hedging transaction in the foreign currency market. So that's another alternative. But in general, the purpose of hedging is not to reduce the average cost, but to reduce the uncertainty about what the cost is going to be.